What's up, guys? What's up, traders? Patrick here. Welcome back to the channel. If you're diving into the fast and exciting world of futures trading, you already know it's a high-stake game. But no matter how much potential there is for profit, protecting your capital is the most important thing you can do. Today, we're going to talk about how to manage risk correctly while day trading the futures market. Are you ready? Let's jump in. Futures trading can be very rewarding, but with higher rewards come higher risks. Anybody can win big on a given period of time, but in trading, losing is inevitable.
I am inevitable.
So what does exactly risk management mean when you're trading futures? First things first, let's quickly recap what makes futures trading different. In futures, you're using leverage, which means you control a large position with a relative amount of capital. This can magnify both your gains and your losses. You also have to manage margin requirements, where a sudden price move against you can lead to a margin call. This makes risk management even more critical. If you're not careful, a single bad day of trading could deplete your account. So let's talk about the key strategies to keep you in the game. So strategy number 1, determine your risk per trade. Just like any other market, you need to define how much you're willing to risk on each trade. A common rule of thumb is to risk no more than 1 to 2% of your trading capital on a single position. So let's break it down. If you're trading with a $10,000 account, risking 1% means you're putting $100 risk per trade. In the futures market, where prices move in ticks, you can easily calculate your position size based on the tick value and your stop loss level. Let's cover that next. Strategy number 2, use stop loss orders and calculate tick risk. Stop loss orders are non-negotiable in futures trading. They allow you to set a predefined level where your position will automatically close if the trade goes against you. In futures, each contract moves in ticks, the smallest price increment. For example, if you're trading the E-mini S&P 500 futures, each tick is worth $12.50. Let's say you want to risk $100 on a trade. If your stop loss is 8 ticks away from your entry price, you'd only take one contract because 8 ticks multiplied by $12.50 is equal to $100. This way, even if the market moves against you, your losses are controlled. Strategy number 3, position sizing for leverage. The futures market are heavily leveraged, meaning you can control a large position with relative little upfront capital. But this can be a double-edged sword. To manage risk, you need to calculate your position size carefully to avoid overexposure. Here's a simple formula to calculate your position size. Using this method helps ensure you're not taking too large of a position relative to your account size, especially when considering how quickly futures markets can move. Strategy number 4, control leverage, and margin exposure. Leverage can amplify your gains, but it can also lead to significant losses if not managed properly. Don't max out on your margin just because you can. Always leave a buffer to avoid margin calls. Let's say you're trading the crude oil futures. The margin requirement might be around $5,000 per contract. If you only have $10,000 in your account, trading 2 contracts would leave you fully margined and vulnerable to a margin call if the market turns against you. Always trade a comfortable margin cushion to avoid being forced out of your trades. Strategy number 5. Be mindful of volatility and news events. Volatility in the futures market can spike without warning, especially around major economic news releases like job reports or Fed announcements. These events can cause massive price swings, making it crucial to adjust your risk accordingly. Consider lowering your position size or sitting on the sidelines during highly volatile times. Trading through these events without preparation is like trying to ride a roller coaster without a seatbelt. Risky and often not worth it. Strategy number 6. Avoid overtrading. Overtrading is a common trap for day traders, especially in the futures market, where you can make quick trades on small price movements, but taking too many trades often leads to emotional decisions which can be very dangerous. Always remember quality over quantity. It's better to take a few high probability setups than to chase every small move. Overtrading can lead to excessive transaction costs and burnout, both which negatively impact your profitability. Strategy number 7. Rules upon rules, meaning you set certain parameters when you're losing and when you're winning. One good example of this is the 3-strike rules, meaning if you took 3 losses in a row, you're out for the day. If you are on a 3-day losing streak, you're out for the week. You rest, you recuperate, be with your family, and you start the next week fresh. This will ensure to protect your capital in those days where you feel that the market is against you. It's very important as well to limit your trade at least 1 to 2, max 3 per trading day. You can also apply this when you're winning. Let's say your first trade, you took a big win using 1 mini. Then you give yourself a leeway to take 1 more trade, but you're using lesser size. Maybe you go micros, 5 micros, 6, 7, depends on you, a lower position size compared to the first trade, and you manage it correctly. If you take a loss there, will ensure that you won't give too much back to the market. Strategy number 8. Keeping a trading journal. Risk management is not just about what you do during the trade. It's also about learning from your past trades. Keeping a trading journal helps you track your performance, identify mistakes, and refine your risk management strategies over time. Write down everything: your entry, exit, stop loss, and why you took the trade. Reviewing your journal weekly or monthly will help you see patterns in your behavior, allowing you to adjust and improve. Day trading futures can be an exciting and profitable way to trade, but without proper risk management, it can be a fast track to losses. By setting clear stop losses, managing your position size, controlling leverage, and staying disciplined, you'll give yourself the best chance at long-term success. Thanks for watching. If you find this video helpful, give it a thumbs up, subscribe for more trading tips, and let me know in the comments how you manage risk in the futures market. See you in the next video.